What is going on, everybody? Welcome back to the channel all about real estate. My name is Lewis and we have a great video planned for you here today. We are going to be talking about cash out refinances and what not to do. So lately I've been hearing from a lot of people that they want to tap into the equity in their home for various reasons. Maybe they want to do some debt consolidation, or they want to do some work around their property. They want to make some improvements. And right now they're locked into a really low 30-year fixed mortgage rate. Their payment is affordable and they have a record amount of equity. So they're like, hey, why can't we refi, pull 30 grand, 40 grand, 100 grand cash out and still have an affordable payment and then be able to consolidate some debt or do some of these repairs? And the answer, of course, is, well, you can, but there are some pros and cons, and there are some things to look out for and some things to avoid, certainly. So I'm going to walk you through some of the details here today. I'm going to show you how I personally evaluate a cash out refinance and give you some tips so hopefully you can make a better, more educated decision for yourself. Now, before we jump into the details, if you wouldn't mind hitting that like button, hitting that subscribe button, and without further ado, let's get right to it. All right, so the first thing that I want to do is walk you through a hypothetical scenario so that we're comparing apples to apples. It's extremely important. And bear with me through some of the nuance and the details here, but I'll try to keep it short, simple, and to the point. So in this example, I just have a mortgage calculator up on the screen. We're going to be looking at a $400,000 loan amount. We're going to say that's the existing debt that you hold on the property. And the interest rate is a 30-year fixed at 2.99% because you refied when rates were super low. So your mortgage payment, principal and interest, this is excluding your taxes and insurance, they are $1,686 per month. Now, let's say hypothetically you want to pull $100,000 cash out. Let's say you want to do maybe 50 grand worth of debt consolidation, and then you have another 50 grand that you want to put back into the property. Maybe you want to renovate the kitchen or something like that. So in other words, you want to borrow another 100 grand on top of that, making your total debt approximately $500,000. And let's just say, for purposes of discussion, the home is easily worth $750,000, $800,000. So you have enough equity. This is where you're at today, this $1,686. I want you to take note of that and remember it just for now. Now, if we go to where mortgage rates are today, this is the inherent problem in a cash out refinance at this point, at least in my view. The average 30-year fixed mortgage today is sitting at, let's just call it 5.5%. And on top of your, title and escrow fees to refinance, you'd also have to pay approximately 0.8% in points and fees in order to secure that loan. So a loan like this on a loan amount at $400,000 or $500,000 if we're taking the cash out would probably run you somewhere between maybe $500 and $7,500 just to refinance to pull out that $100,000 cash out. So you're probably saying, well, Lewis, get to the point already. What does that mean? Why is that important right now? I have plenty of equity. I want to go ahead and take it out because I want to do some of these things. And if I pay off some of this debt, ultimately my out-of-pocket will probably be less anyway because I have some high-interest credit card debt and maybe I want to pay off an auto loan or something like that. So even if the payment goes up a little bit, well, then overall it should even out. And for that reason, you may be correct. However, I think there is a better way. So let's just assume, for example, you want to finance the $500,000 and it would be at 5.5%. Your payment would now jump up to $2,839 and it was at $1,686. So this is a difference of approximately $1,153 per month. So nearly a $1,200 increase in your monthly payment in order to take out that extra $100,000. Now, maybe between some of the debts you're paying off, maybe it was about $1,200. So if you're combining it all into one, doing some debt consolidation, maybe that just evens out for you. But the question is there a better way? And in my view, there absolutely is. The problem, in my opinion, with this is that you're restructuring all of the debt. Not just the $100,000 that you're borrowing, but also the $400,000 that you already owe. The 400 grand is fixed at 2.99%. That's the lowest rate you may ever see in your life on a mortgage loan. Why would you ever want to touch that? So in my view, I would personally leave the 2.99% fixed rate debt exactly the same, and I would look for an alternative option because I don't want to take the 3% rate or just under 3% up to 5.5%. That's 2.5% higher. And of course, that's a 30-year loan. That makes a tremendous difference. It's $1,200 more per month when you're restructuring all of the debt. So the question then becomes, what do you do? Well, for me personally, I want to keep the debt at 2.99%. So here's what I'm going to show you, or what I'm going to bring to your attention. What you can do is you can, instead of doing a cash out refinance, you can do what's called a home equity line of credit, or a HELOC. Now, there are several companies that do this. You can go through a mortgage broker, but in my personal experience, the credit unions and larger banks are going to offer better terms, better pricing, and lower fees. So I'm going to give you an example here. Golden One Credit Union is a local credit union here in California. They have these home equity line products. Now, what you're going to get with a HELOC is you're likely going to get a higher interest rate because it is a mortgage that is in second position. However, that HELOC in this example is only going to be financing the $100,000. You're not restructuring all of the debt. So in this particular case, their home equity line of credit for a variable rate, which means it can change, is starting at 5.5% with an APR of 5.5%. Now, because the rate and the APR match, that means that there's virtually no fees associated with this. So the beauty of a HELOC is generally there are no closing costs. Maybe they have a couple $100 built in for an appraisal or something like that, but generally there is low to no fees that are associated with these products. The way they work is they are a 30-year fixed mortgage with a 10-year interest-only draw period. So you can draw from those loans for the first 10 years. You can use what you want, when you want, and you only pay interest on the balance. It is going to be a higher interest rate, but it will only be on the $100,000. We're going to talk about that here in a second. Now, with this particular company, let me move my screen over just a little. They also have a fixed rate product as well that taps into your home equity, and that starts at 4.90. So for a little bit higher interest rate, which we'll talk about in a second, you can actually get a fixed rate product, so you're not worrying about rates going up or moving down or just fluctuating on a month-to-month or annual basis. Another example would be Patelco Credit Union. I don't know if they're just local or if they are in various states, but if we scroll down here, they have a home equity line product as well. They have variable rates as low as 5.25%, and they have fixed rates as low as 5.72. Those are really good rates for a mortgage that's in second position. Let me get to the point in what I'm saying here. In order to do that, we need to look at what we call the blended rate. I'll go ahead and link to the blended rate calculator here in the show notes so that you can run a specific example for yourself. If we're sticking true to the example that I mentioned here, we're going to have a $400,000 first mortgage, which is financed at 2.999% already, and then we want to borrow about $100,000 in order to do some debt consolidations and renovations on a property. Now, if we stick with the high end here, with regards to the interest rates on these second mortgage products at Golden One Credit Union, we saw one at 6.490%. So again, a current balance here, you have $400,000 first mortgage, 2.99 rate, $100,000 second with a 6.49 rate. And now when you go ahead and hit calculate, it does something very interesting here. So it shows you the total balance, which we know is $500,000. We're using very easy numbers here, but then it calculates what we call the blended rate. So it's essentially taking the average between what you're paying on your first mortgage and then what you would be paying on your second mortgage, and it blends it together. Now take a look at that interest rate there. Your rate, your blended rate, would go up to 3.697%. Now, the average mortgage rate today is 5.5%. By taking out a home equity line of credit as opposed to restructuring the debt in a first mortgage, you would be paying 3.697%. Let's round up to 3.7%. As opposed to the 5.5%. Now let's calculate the difference real quick so you can see the numbers yourself. If we take the $500,000 and we run it at 3.7% as a blended rate, your total monthly output there on a 30-year fixed term would be $2,301 per month. So $2,300 per month versus the average 30-year fixed mortgage rate at 5.5% would bring your payment up to $2,839. So just a little over a $500 per month savings, and that is with the highest fixed rate home equity line product that I saw here by just doing a quick Google search with one of the local credit unions. So in other words, you save $500 per month in interest by taking out that equity loan or that second mortgage using a fixed rate product and keeping your first mortgage rate exactly the same. So now you may be thinking, okay, I get it. I totally understand that, but what is the downside to taking out a home equity line of credit? Well, if you do a variable rate home equity line, that means that the interest rate can go up or down depending on the market. Lately, we've been in a rising interest rate environment, which means that as rates go up, if they do continue to go up, then the debt service on that second mortgage is likely to rise. Now, the way you remedy that is by taking a fixed rate option, which unfortunately comes with a higher rate today. In my opinion, I like the fixed rate option because I know that that rate is locked in, helps me personally sleep better at night. Not everybody feels the same way. Now, the other thing to be mindful of with a variable rate HELOC is that you have a 10-year draw period that is interest only. So what can happen is if you're just paying the minimum monthly payment, you're only paying interest on that loan as opposed to paying down the principal balance. And then after that 10-year draw period, it actually converts to a 20-year fixed mortgage in most cases, which means that the payment will jump up pretty dramatically. The way that you remedy that is that you go online, you do a Google search, find a mortgage calculator, type in how much you owe or how much you're going to borrow on that home equity line, and then just look at it in a 30-year fixed fashion and pay that extra amount each month towards your principal balance. And then the last thing that I want to talk about is the misconceived notion that these HELOCs or second mortgages really caused the great financial crisis in 2008. In my personal opinion, this is not true at all. I mean, sure, were people borrowing equity and then spending their money frivolously? Yes, in some cases that is true, but that's just true in any market. If you don't have a prudent plan to manage your finances, then you can easily get caught up in a bad situation. With that said, the bigger cause of the great financial crisis was not second mortgages, but rather loans that shouldn't have been given out in the first place. Things like subprime loans, where they verified no income, no assets, or no job, and folks who did not have a worthy credit history of securing those loans, they probably shouldn't have got them in the first place. And once those loans adjusted or the rates shifted and their payments went up dramatically and their equity was so low or went down so they were underwater, it put them in a really bad situation. That, in my opinion, was the root cause, not second mortgages. Now, with that said, personal finance is personal, and some people would prefer to just have one mortgage rather than two. When you have a first mortgage and a second mortgage, you have two different mortgage payments that you're paying for. For me, in that scenario where you save $500 a month, it would absolutely be worth taking out that second mortgage as opposed to restructuring all of the debt at the higher interest rate. Even if my monthly obligations between my mortgage and doing the debt consolidation, if it just evens out, or even if I am net positive a little bit, I'd rather do something like what I just showed in this example to save more money. But ultimately, that's a personal decision that you would have to make for yourself. But I would be remiss in not sharing this information and showing you how to calculate it so that you can look at this yourself and make an educated decision. And with that, that is all that I have for you here today. I hope you found this information useful. Leave your comments below. What are you seeing out there? What would you prefer to do? If you have a different idea or would like to add to this, please leave some comments below. And if you haven't done so, please hit that like button, hit that subscribe button. We'll see you on the next video. Thanks so much.